Well, let's catch up with what we're seeing more broadly in the markets and some investment opportunities. Marc Wait joining us from Providence Wealth Advisory Group. Marc, good to see you.
Thanks, Andrew. Pleasure to be here.
All right, so obviously some concerns there from Christopher Joy as to where we're at. I mean, how do you see us travelling at the moment, I guess particularly in Australia with the economy, the outlook there, given what we've just been through, it's sort of uncertain times remain. How does that inform your investment decisions?
Well, I think it's a really good point. And I think if you think about what's happened, we've had a significant increase in interest rates, and we're just starting to see the impacts on the economy. We've recently just had our quarterly investment committee meeting, and one of our contributors there has sort of opined that potentially 55% chance of a recession in Australia in the period ahead. So we're moving through this period of sort of mortgages adjusting, higher interest rates, and some pressure on sort of household and corporate balance sheets.
If we were to slip into recession then, or even perhaps with the possibility we will, how do you position your portfolio as a result?
Yeah. So I think in terms of opportunities from an equity perspective, potentially we're seeing slightly better opportunities overseas compared to Australia. So we've been underweight Australian equities, and we continue to think that that's probably the appropriate thing to do in terms of portfolios. More recently, we've increased our allocation to fixed income, having been very, very underweight fixed income from that perspective. And then we've also made an allocation consistent with what was talked about previously in terms of a coming default cycle. So we made an allocation earlier in the year to a distressed credit manager. And we think it's going to be a really interesting period of time because there's going to be a lot of sort of corporate debt to work through, particularly in the US, where you've seen a real boom in corporate debt. And there'll be a lot of debt that will come up to mature over the period ahead. And no doubt, like the chart you showed before, there'll be an increase in defaults.
All right, particularly, I guess one sector under pressure there is commercial property. Are you seeing opportunities there as a result?
Well, commercial property is really interesting. So I think last year, if we look at the listed property sector, there was a real dichotomy. So the listed A-REITs was down around about 20%, whereas the actual unlisted market was up 6%. So quite a strange sort of dichotomy there. And then what we've seen more recently is a little bit of a bounce in the listed market. So that's been up almost sort of 6% year to date. But against that, you're starting to see direct commercial property values come down. And we are starting to see some interesting opportunities, although that's very, very early at the moment. So we're seeing things like property centres where shopping centres have been selling at cap rates above 7%, whereas historically those cap rates would have been closer to 5%. Commercial offices recently, we're seeing some of the sort of lower quality commercial offices trading at cap rates as high as 8%. Whereas only a couple of years ago, that would have been 4%. So we're going through this ongoing adjustment process where valuations are coming down and cap rates are going up. So we think over time there will be opportunities there. We think there's probably still a lot of work to do as well.
Now, regionally, you were saying there at the outset, perhaps you're a little more underweight Australia. You're looking elsewhere, offshore. Where in particular?
Yeah, so I think it's been a really interesting year, and I think as one of your previous commentators talked about, the rally's been very concentrated in the US. And we've had some very good managers in our portfolio who've been able to take advantage of that and owning some of those leader stocks in the portfolio. But as we look at sort of broad valuations, what's becoming apparent is you need to be quite selective about where you invest in terms of global equities. So we're seeing some good value in mid-cap stocks. So if you look at the valuations in mid-caps in the US, the S&P 400, their price to earnings ratios are around about 15 times, which compares to the broader market on a 1 year forward basis of closer to 19 times. And they're paying a lot higher dividend yields. So potentially there's some interesting opportunities there in global mid-caps. We've also had an allocation to Japan for quite a long period of time.
Just before we get to Japan, can I just pick you up on the States?
Yeah. Yep.
And you were referencing there, we were talking about earlier about the Magnificent Seven, given that narrow leadership. And so many fund managers miss that, of course. Is it too late? Do you need exposure there?
We think there's some very interesting dynamics going on in the economy. And I think if you look at some of the companies over there, you're seeing that they have significantly wide margins compared to other companies in the market. So if you look at the sort of tech sector, the tech sector margins are significantly above other companies. So I think it's important to still have some exposure in that place. I don't think it's necessarily the point to say we no longer want to have exposure within the technology space, but I think we need to be quite selective and have managers that can operate around that sort of area.
All right. Sorry, Mark. I
That's
disrupted you when you were saying, okay, you're also looking at Japan. What specifically are you looking at?
Yeah, so we've had a core manager in Japan for a number of years, and that's done very well. So the Japanese market's had quite a sort of good period of returns. But what we've also noticed is there's been real institutional change in Japanese corporates. And so what we've done recently is make an allocation to a Japanese activist equity investor. And I think in that space, what's really changing in Japan is that the valuations are not overly onerous. So if you look at sort of the topics on a 1 year forward basis, that's trading at 15.1 times earnings, reasonably good earnings growth forecast in the periods ahead. But the actual structure of the companies are changing. And that's being driven by the Tokyo Stock Exchange, where they have companies having to give a plan about how they'll get the valuation of the company above 1 times price to book. So that's quite a sort of novel approach. The second thing is shareholder rights are quite strong. The third thing is around about 40% of companies on the Japanese Stock Exchange have 20% cash on their balance sheets. So there's a lot of opportunity to get returns distributed to shareholders through share buybacks, special dividends, other areas like that. And indeed, the manager that we've invested with has got quite a long track record of being able to engineer change.
Mark, you're talking about, obviously, you're talking about equities there, the role that you've got for bonds and fixed income in the portfolio. What about gold?
Yep.
In fact, interestingly, we've got an investor event focusing on that very asset this morning. Do you have that in the portfolio?
We do have gold in the portfolio, and we've had it for quite a long period of time, and it's been a real sort of source of stability in terms of returns. And indeed, if you look at the sort of gold return over 20 years, I think in Australian dollar terms, it's been close to 9% per annum. So it's been a fabulous return, aided by both the increase in the gold price and also the depreciation in the currency over that period of time. And I think what it does at the moment is there's so much going on in geopolitics, and there's quite large diversification in terms of countries' reserves into gold, that it's meant that the floor under gold has continued. And so we continue to think that it's quite an interesting sort of hedge in the portfolio. It's provided good returns, and we think going forward it continues to be an attractive asset in a balanced portfolio.
Yet we have seen that inverse relationship with the US dollar, the dollar remaining elevated. What's your expectation on that front?
Yeah, so I think that's a really good point. So you want to watch quite closely at what point does the US dollar start to turn, and that's probably one thing that's a little bit of caution in terms of gold. I think the second thing is gold's done well in an environment when interest rates are quite low. So in this environment, interest rates have gone up, but the reason you keep it in the portfolio is because of that sort of geopolitical hedge. So you see countries like Russia clearly no longer want to own US treasuries. They want hard assets as a part of their reserves. Same with China, same with a number of other countries as well.